What's up, everyone? Welcome to Let's Talk Markets with Dave Lauer. I am your co-host, Pink, and today we have a very special guest welcoming Greg Lee, who is the managing director of Paxos. Thanks for joining us, Greg.
Thank you for having me.
Now, before we get started, Dave, I heard that condolences are due your way. your fantasy team isn't doing so well, maybe?
Well, look, you know what? Fantasy football is not going well right now. Real life football is not going well right now. The Eagles just suck. I don't know what happened. They were awesome, and now they suck. It was like that. So, yeah, bad coaching, as Dave is saying here. I don't know, Greg. Are you a Giants fan? Jets fan?
I'm a fan of the game. I kind of love how passionate people are for different teams and those sort of things in the area. But I love watching all of them, right? And I actually find it just as amusing watching the pain on your face from a loss from your love of this team as I do watching the game. So
Yep.
It's a double win for me.
I appreciate that. I love watching the pain in my friends' faces when they lose. You know, I'm a big Schadenfreude guy when it comes to sports, and yeah, I don't know what's going on. You know, last year, it could not have been a better year to be a Philadelphia sports fan. And this year it was shaping up to be something similar. But you know what? That should have been the first thing that should have been the red flag, because you're never, as a Philadelphia sports fan, you don't get good stuff. Not good stuff, especially not 2 years in a row. It doesn't happen.
I won't mention to you that as an Australian, I was Ben Simmons fan, so we can move on quickly.
Oh no. Wait, do you like rugby? I mean, Australia is big in rugby, right?
I do like rugby. Yeah, the Wallabies, the Australian rugby team. Yeah, we just had our worst ever performance ever at the World Cup. So you know, I feel your pain there.
Yeah. All right.
Well, that wasn't fantasy league. That was obviously the real thing. Yeah. National pride and all go. Yeah.
Yeah. Last year in fantasy, I won the league in the regular season and then shit the bed in the playoffs. Basically, this year wasn't as good. It wasn't happening this year, but it still hurt. Just lost in the first round of the playoffs. So that's it. Everything you wanted to know about my fantasy life, fantasy sports life, I should say. There you go.
Well, I just had to get him kind of primed up for this, get him fired up before we jump into this, Greg. And before we do, why don't you tell us a little bit about Paxos? I got to say, there's a lot of buzz about Paxos online, so I've learned a lot coming into this, and I'm really interested to hear what's going on with Paxos.
Sure. So Paxos is a highly regulated blockchain infrastructure company. You know, we're trying to change the plumbing of the financial industry. And we've got a broad spread of products which covers across digital assets, crypto space, commodities, securities, and cash products as well. You know, in our commodities business line, we have a tokenized gold product, which is actually a regulated issuance under the New York Department of Financial Services. Pax Gold has about $500 million in assets underneath it. But we've also got a settlement platform into the commodities world, the LBMA metals market in London, where we settled 150 billion worth of assets on that side. On our core crypto platform, though, we've got over 500 million users through our partners that are connected there. We serve people like PayPal, Venmo, Interactive Brokers, Mercado Libre, Nubank, etc., all across the world that provide digital asset infrastructure to them. One of the biggest things we do is provide stablecoins to the market, regulated stablecoins into the digital asset space. We've done that under the New York Department of Financial Services guidance out of New York. And that's allowed us to really bring regulated products into the space and differentiate there. And then on the security side, we've been working for a number of years to apply to the SEC to become the second clearing agency for the US equity space as well, which has been a huge undertaking that's still underway for us. So we're a broad company, about 11 years old and 300 and something people now. So trying to do good things for the industry, but do them in the right way.
All right, so there's a lot to talk about there, but I want to ask you just one question about this Pax Gold thing. Where is the gold stored, and what is the code to get in?
What are the exact coordinates?
Yeah. Obviously, probably not going to disclose that. No, they probably wouldn't even tell me that. But it sits in the physical vaults of LBMA banks in London. I believe might be split across 2 of them or something, but yeah, it's there. And when you actually get a token of Pax Gold, it's physical allocated gold, the product. So when you get the digital token, that actually references the serial number of a bar that's there. And if you hold enough tokens beyond a full bar, you can redeem for a bar if you like. If you're less than a bar amount, then you redeem for cash.
Wow. Okay, so this is fully backed tokenized asset on chain. And what kind of chain is it on?
It's on Ethereum. Most of our products are on Ethereum today. You'll hear about other chains coming on soon. Because of the highly regulated nature of what we do, we work really closely with the Department of Financial Services in New York to approve any new chains that we work on. So that does take a little bit extra time, but it gives our customers, some level of safety that, once we're on that chain, that there's good oversight and regulatory attention being paid to it.
Interesting. Okay, so I want to get into stable coins to start. We were actually talking with Byron, the lead developer at Loopring. I don't know if you're familiar with Loopring. They've got some interesting decentralized technology, but he was really, bullish on stable coins as that first sort of on-ramp into crypto for most people. And one of the things that I think a lot of criticism that the crypto world gets is, what's the application? What is this more, show us something more than just some financialization and trading. And I think stable coins is one of those first, applications with clear benefits to people and a simple use case. So maybe you just want to give us give our listeners a high level overview of what is a stable coin and what is Paxos doing here?
Sure. So, well, I'll start at the end of that. And what is Paxos doing? So Paxos is issuing regulated stablecoins, again, under the New York Department of Financial Services guidance. We've launched, 3 stablecoins under that guidance. Our own one, USDP. We launched BUSD. And then most recently, we launched PYUSD, the PayPal coin as well there. So regulated stablecoins. And what the regulator part in there means is that the operation, the issuance, the governance, the reserves that are allowed to be behind them, etc., is all mandated by a regulator. So it's not just arbitrary things that we decide, what we'll invest in, what we'll do, and how the product will work. There's really a regulator making sure that that's there. And, their regulatory regime really focusing on ensuring that that coin is always one-for-one redeemable. So if you have one of these issued stable coins by us, you can always come back and get $1 for it, right? That's the underlying premise there. But stablecoins are a pretty unique product. For those in the traditional finance world, they're very similar to sort of narrow banking concepts where they're fully backed and reserved. So if somebody comes and gives us $1 for a stablecoin, that dollar is only allowed to be invested in a very small number of assets, right? It can either stay in insured bank accounts, and that can either be FDIC insurance or private insurance over and above that. And it can then be in repo markets, in short-term treasuries up to 90 days as well. And that avoids some of the issues you've seen with some of the bank runs, Silicon Valley Bank, these sort of things, et cetera, where they had much longer duration treasuries and then lending short, et cetera, or lending long, borrowing short. It's a very structured product in terms of the controls around it for that goal of redeemability, right? And that's very different from some other products that are talked about in the market. One of those is what we would call a deposit coin, where someone like what JP Morgan's done some great things with their Onyx platform, and they've got the Onyx coin there. But that's a deposit coin, and the key difference there is that's issued by a bank. It has some regulatory pieces, all that sort of thing. But the assets behind it can actually be rehypothecated, right? They can be used in the fractional reserve banking system, lent out, those sort of things, etc. Obviously, with someone of JP Morgan as being a SIFMU and backed by the US government, that's a reasonably safe activity, but it's still very different from a stablecoin asset there. And then the third thing that people talk a lot about is central bank digital currencies, which is Federal Reserve backed money as well. Again, different from the stablecoin in that they're a fully backed asset. So for the point of trying to bring very safe assets on chain and having that level of disclosure and regulatory oversight, we think that stablecoins is the safest of all of them, and the one that gives you the best cash-like products to produce a digital dollar for people to use on chain.
And what are the benefits to people of that digital dollar? What does that bring that is superior to, let's say the current rails?
Sure. Well, let's talk about the current rails for a minute, right? Most people don't realize how much the U.S. system in particular is quite an out-of-date, core banking system, right? It has the most advanced credit card system in the world, but not on the banking side. And what that means is there's a lot of layers and systems built that really have a lot of capital buffers to make things feel instant for you when they really aren't, right?
Mm-hmm.
And what that does is add intermediaries, friction, and invariably cost to the equation. So
I once had to do this project for a large financial services firm to help implement ACH, right? I'm sure you had to do. It's the craziest system. Like if you were to try and design an insane system for transferring money, I feel like this is what you would come up with. Like the money gets transferred maybe in a couple of days, but not really. And it appears in your bank account, but it's not actually there. And it can be clawed back for up to, I don't know, like weeks. It's like, it's the most insane thing. And how can you run a business that depends on electronic money transfer using a system like that?
Yeah, it's painful for a lot of businesses out there, right? And there's a lot of credit in the system, and credit means risk, right? And exposure to counterparties, those sort of things. And so a stablecoin really goes back to those principles of instantaneous, guarantees of ownership, those sort of things. And some of the most attractive things as well is that a lot of people conflate stablecoins with some aspects of some of the crypto assets. And a lot of that couldn't be further from the truth, right? Not only is there regulatory oversight of these products, but there's features and functionality built into them that allow the regulator to do their job, right? And that job is obviously, blocking certain people and freezing assets and those sort of things. It requires, because we're regulated, it requires, legal intervention to carry out those sort of activities, but it's all built there. So, some of the talk you hear around mischievous uses of these things, etc., is actually very, very difficult to do with these things. And anytime it does happen, every time you've seen a ransomware paid or something like that, there's usually a story a little while later about the FBI going and getting it all back, right? Because of the traceability of these assets. So there's a lot of benefits there. And I think that the problem you really get is the cost to go from one system to the other system has to be borne by someone. So everyone's looking for that panacea that makes it a sort of no-brainer investment to go in there. I think it'll probably happen more incrementally. And certainly, we talked a lot there about the US system. When you go abroad, especially moving US dollars abroad, that becomes a much, much harder problem. And a lot of the use cases for stablecoins are being used in international remittance, both at the corporate level and also the retail level. And because of those layers that you need to go through, we talked about those domestic layers, right, that you need to go through. But if you need to move into one of the big remittance corridors to Mexico, to the Philippines, to India, et cetera, people trying to send, money back home to families from the US, that starts to get really expensive, to the point where some people are paying 5 and nearly 10% for some of these transfers for a few $100s. And, when they move that onto stablecoin rails, they can have, more oversight, less counterparties involved, and suddenly go to, low numbers of basis points for a transfer of that nature. So this
Western Union is not an exemplar of modern technology.
Exactly, right. And there's real need and use case, and that can be disruptive for some of those intermediaries, though.
So, so let's talk about the PayPal stablecoin for a minute. To me, and again, in the context of some of the conversations we've been having on the show about moving to a more decentralized financial system and sort of what maybe the future of money might look like, this seems like a really big deal to me. This seems like one of the most important steps forward for crypto in terms of broad adoption and bringing not just getting it adopted, but bringing benefits to people. Does everything you just explained sort of all fall under that? I guess, what do you say, PyUSD or PYUSD?
PYUSD, yeah. Okay. Yeah, absolutely, right. I mean, PayPal has been a close partner of ours for a number of years now, and they're a company which has obviously been innovating for decades now. The PayPal coin really takes everything that we just talked about and then puts it into an established network, right? And network effects matter in these things. PayPal has over 300 million users and 30 million merchants on the network, right? And so when those people want to move around money today, PayPal has to paste over all those problems in the existing system that we talked about, right? That's expensive, and the users pay the cost of that. Being able to adopt stablecoin is starting to allow them to do that in a much lower cost way for their users, right? And some of these use cases in different payments things that will come up there will be very powerful adoption. And the thing that I love about someone as advanced as them and their network as big as those is you can't even dream up the sort of ways that it will be used to solve problems that will come down the pipe along the way.
Is it being used today, like under the covers at PayPal? Do people even know when they're using it?
People know when they're using it today, right? It's listed within the crypto part of things, and you buy it with either dollars or crypto or whatever you want there. In a lot of cases, though, so you can hold PYUSD and you can use the PayPal checkout services at some of these 30 million merchants, and you can actually pay with your stablecoin or with your crypto for that matter. We power all of that for PayPal through the Paxos network. So we've got lots of wonderful screenshots of different people when they've been buying some random thing. We had somebody the other day that was on a flight buying Wi-Fi, and they used PYUSD to pay for the purchase of the Wi-Fi on the plane and things like that, right? So there's lots of cool applications starting to come. And I really feel that as we go down this pipe, that point you just made about do people know they're using it? I think today they really do. But over time, more and more, that abstraction will happen. And I think that's when you really know that you've got that adoption there where people can know they can't. And that started to happen there through the PayPal network, where those merchants are taking payment from PYUSD, and behind the scenes, they're getting fiat today. In the future, they might actually want to accept PYUSD because then the merchant can get their money instantly rather than waiting, terms and days and things like that.
Yeah, that's so cool. So let me ask you this, because I'm starting to think about CBDCs. We've been talking about it a little. Next month, we're going to bring on Chris Giancarlo to talk about the work that he's done in the Digital Dollar Project. You, I think, see stablecoins coexisting with CBDCs, and I think a lot of people in crypto do. I don't know if a lot of people in government necessarily want that future. Do you think, are stablecoins private money? Is that like, is there a risk that we're almost taking a step backwards? Because you know what I mean? Like private money before we had this centralized system worked in some ways, and in other ways, really didn't. I guess if yours is fully regulated, it makes a lot of sense. But if you're something like Tether, which is much less regulated, and not quite sure what's in there, I don't know if it works as well.
Sure. I think all very relevant points, right? I mean, I can only really speak from the point of the regulated coins that we issue. And in that instance, we're investing back in U.S. treasuries, like in the U.S. government, those sort of things, right? The money is still in the ecosystem there. Offshore providers like Tether and others have gained enormous traction. And some of that is because of the lack of clarity and regulatory regimes and those sort of things, etc. And some of those because people explicitly want a product that isn't regulated and doesn't have someone that can come and seize assets. But I think you've seen that even Tether has started to freeze assets for people at the request of governments and things recently. So I think that trend is starting to shift there. Okay. When you talk as well around central bank digital currencies and how people work with those, I think it's important to take a step back and think about the world we operate in, which is an intermediary market, right? The Fed regulates Fed member banks, and they regulate their users, etc. If you think of the practicality of a CBDC going to you, me, and everyone else at a retail level, that kind of means that somebody has oversight and is regulating from the top right down to the retail level. And there's no regulator staff to do that. Right? That doesn't exist today. That's a very different size and scope of what would be needed to be done at that level. And I personally just don't think that that's practical. I think the intermediary market has, a lot of merit, and I think that you will see, things like a CBDC, certainly at least at first, in that intermediary layer, and then stable coins or deposit coins out to the retail individual.
Okay, let's switch gears a little and talk about peer-to-peer settlement and clearing and how awful the DTCC is. I know I hear a lot that a lot of people want to see the settlement and clearing process decentralized. I would say outside of finance, I hear a lot of that. Within Wall Street, you get a lot of fans of centralization and, frankly, a lot of fans of the lack of competition in the settlement and clearing space, because a lot of people make a lot of money under the current system.
Sure.
So, I think, as far as I know, and feel free to correct me, but you guys are the only ones actually implementing peer-to-peer, I should say, peer-to-peer clearing, I believe, sort of through smart contracts. So, can you talk a little bit about what Paxos has done here and sort of where the tech stands and where the regulatory system stands?
Yeah, absolutely, right. And I think it all stems from the point you just made around competition, right? The DTC, they are a monopoly in most of the markets that they operate in today, but that's been by design, right? They were a consortium amalgamation of things that were there. So we've sort of ebbed and flowed from decentralized to centralized, and maybe we'll change again there. But they've also done a lot of great things for the industry, right? And they've got a lot of great smart people over there. But like a lot of legacy institutions, they're held back by a few things, right? The fact that they have legacy infrastructure. Most people don't realize that the bulk of the clearing and settlement infrastructure runs on COBOL mainframes, right? So it's and that was, at the time when it came in, that was cutting edge, right? That was them driving the industry forward, right?
40 years ago,
but through lack of competition, that takes away incentives to reinvest and fight and change and those sort of things. And so then you get left with these sort of problems here in the market. So what we're really trying to bring is competition to the market. And what we believe is a different model can work there. There's some elements of it that you could call decentralized, but due to both the regulatory constructs that it operates under in terms of being a fully registered clearing agency under the SEC guidance, in addition to that, what we really talk about is bilateral activities, right, between brokers. Still has to happen through that regulated institution, though, for a bunch of legal and regulatory reasons there, but takes away the need for a central entity for trades to be novated to. For anyone that wants to get into the weed of clearing, right, and how things work today, there's a very
you're in the right arena for that. We definitely want to get into all the plumbing.
Go deep as you want.
So street side clearing, the initial clearance that happens in the market today, by and large goes through the NSCC, right? And they're a facility which does basically the netting and then the novation process. And what they do is they novate trades over to a central counterparty. What people forget about central counterparties is that they're entities. And that entity needs to be funded. It is the buyer to every seller and the seller to every buyer on the street. So it faces every single participant in the marketplace. And to do that and be a safe entity under the modern guidelines, you need to have a lot of money sitting there. And for a long time, this thing had a few $1 billion in it, sort of got up to $5-6 billion. And then when trading went crazy a few years ago, this thing was up in the tens of billions of dollars, very quickly. That's a lot of money tied up for, just so that we can get some netting and settle all the trades at the end of the day. And there's a lot of reasons and evolution that got us to this point. We started working a number of years ago with some of the participants in the market that really took a look at what happened in 2008 when Lehman Brothers went under. And they saw that during that failure, that clearing fund or that central, pool of money that's there to protect everyone, that backstop fund, wasn't used. And they started to question, well, in the biggest sort of, bank blow up we've ever seen, why was that fund never touched? Why didn't we need that?
Really?
Right? And the reality was, the way the system is built, they were able to use the margin that was supplied in there to settle most of the replacement risk. So when Lehman goes under and they can't deliver to you, I'm a counterparty to that. Well, I still need the shares you promised to me, so I have to go into the market and buy them. The price may be different, and that change in replacement risk cost has to be covered by the margin that Lehman would have put up, that they would have perfected the lien on and taken in. But beyond those trades, they simply failed a lot of trades, right? They didn't use the clearing fund to perfect them. And there's a reason for that, right? The clearing fund is seen by several on the street now as somewhat of a nuclear option, right? It's a lot of capital from a small number of banks that are in there. And if they use that capital, it's gone, right? And so suddenly the value of those banks changes overnight and things like this, right? So, what's happened in the dynamic shifts over the last few decades in the US clearing market is pretty profound. And you've got, the top 20 clearing brokers in the US clear 99% of equities trades. The top 10 are 86%. The top 5 or 6 are over 50% of daily equities clearance. So it's a very concentrated number of people. So as the market's grown in size and scope, right, and volatility, then you've got less and less participants putting up more and more capital. This starts to stress the system, right? And we saw that, through the meme stock fiasco and what happened there, right? So what we've come up with is a model where we look at what does the market want, right? The market wants safety, right? The market wants protection. The market also wants, capital efficiency. And so how can we achieve those two things there? We believe that, central clearing is definitely valuable, and that's where we get the netting benefits to flatten everything out. But a central counterparty, we think actually isn't needed there, right? We think that you can actually novate those trades between participants in real time. And what we built at Paxos is a clearing agency model where we run a multilateral net in real time throughout the trading day, that we can cut that net and settle at any time, right? And the market now is moving from T2 to T1. We could set that to settle T0, end of day. We could set that to settle, every few hours, these sort of things, etc. So this is what we think is more of an efficient frontier of how to move the markets forward, right? How to have not only this real-time netting function, but then on top of that, real-time margining and transparency to people.
I think that to me, that's really the key part here, because I do know, in the current system, you have, I think it's called like ex-broker clearing, right? Like you can go like bilaterally on a one-off basis, but there is no visibility or transparency into that, from the system at large, right?
Maybe not externally, but if you're a DTC member, an SEC member, right, and you're there, you have what they'll refer to as a RAD queue, the receive and deliver queue, etc. And things will pop up in that when people are trying to deliver to you or ask you for deliveries, etc. So there's operational teams at these things, at these firms, that will look at that, and that feeds up into risk things and other things, etc. Mm-hmm. But once you're outside those institutions, no, there isn't, right? And people do settle that way. We've talked so far about street side clearing, the initial clearance of trades from the market. After that is done, then there's the institutional or client-side clearing as well that happens. That's a whole nother leg, and that does happen largely bilaterally as well and isn't netted down because those firms, pension funds, asset managers, etc., they're not NSCC members. So they can't use the advantages of those netting and other features that it has, and it has to happen bilaterally out of that side of it as well.
So I think you told me before that a lot of FTDs actually arise out of that side of the pipeline. Is that right?
Correct. Yeah. So in the, if you're an institutional broker trading for somebody, then you might get a large portfolio that comes down to trade. You'll execute that throughout the day. And then at the end of the day, you'll wrap things up. You give the finals to the asset manager and tell them to send in allocations. And they'll send in allocations to then, send it across these 100 funds that all the assets need to go to, etc. And sometimes they get that wrong, right? The bigger, more sophisticated asset managers are highly automated and don't do much wrong there. But when you go down people that haven't had the money to invest in technology, etc., there's still manual processes there. And so, on T+1 or maybe even later, they might say to you, oh, actually, I gave you the wrong account there, right? And that allocation was wrong. Guess what? That ends up being a fail to deliver in those metrics there. So of that, 4 to 5% fails, only 1.5% is street side fails. The rest is largely driven by the institutional and client side. And one of the great things in the SEC's talk around going to T+1, was them pushing for T0 allocations and moving that down and really pushing for investment in that space.
Do you think that the netting process covers up a lot of fails?
To some degree, the CNS, the continuous netting system inside the NSCC, does allow for fails to be re-netted, right? So if I had a fail yesterday, it'll come into the net today, and then it could get netted out potentially. So yeah, it happens, right? And that's certainly advantageous to a lot of how the market works. And the US market is unique in that we have a market-making regime in the cash market, right? That is not something that exists in most of the developed markets internationally. And a market-making regime means that you have a unique set of firms that are designated to provide liquidity for the market, right? Which they do very well in the US market. But they're also allowed to do certain things. One of those things is to be able to go short and cover later. I think that there's a lot of misunderstanding about that in the market. And some people will think it's, crime and skullduggery and those sort of things going on, etc. But it really isn't, right? These market makers are, they've been given a designation that permits them to do things. And they're also, they've got conflicting things on the other side where they may not have inventory in something. But by being a market maker, they have to quote on these things. They have to be up there and they have to be doing stuff. So they're allowed to do that, and they know that they can buy it back later. And so certainly a lot of the, people thinking there's a lot more naked short selling in the market than there really is, it's related to some of those facilities that are not well understood.
But I am hearing like an underlying theme to what you're saying from 2008 to now of rehypothecation affecting inconsequential FTDs that lets everything go in perpetuity. I mean, that does sound like kind of what, and I am kind of, I'm summarizing here and paraphrasing.
Yeah. But not rehypothecation, which is causing it. The bulk of, I would really love to see some statistics that talks about rolling fails over time, right? Typically fails are cleared in 1 to 2 days. It's very quick, right? There's not much.
But are they cleared through delivery? Or
no transparency.
Rolling, right?
You've got to imagine that, most are, some may not be, right? Some might be netted out, etc. The net result for the other participant is they receive their stock though, right? And that's the important thing, is that when you have a big net like this, it's really about trying to find the, most efficient way to get people delivery of stock they bought or, cash when they sold type of thing. But typically it's delivery of stock when you bought that's the problem there. The ones that really roll on is usually because of something more structural, right? Like a stock is suspended or frozen, or there's, other issues with a counterparty, something like that. They're real outliers. That does not happen very often, certainly not in the major stocks.
Yeah, you and I have talked, we stand on different sides of this. I don't think the market making or the Madoff exemption is necessary to make efficient markets. And, I'm not willing to give market makers the benefit of the doubt that they're not abusing that status. But
look, I think, you repeated you put a tweet up the other day. There was a story in the Wall Street Journal. The retail participation is the highest it's ever been in the US, right? I think it's very difficult to argue that despite what we can nitpick about the system, right? And we certainly can, right? The people in the market is at its highest, and there's a reason for that, right? And that is because they get a very good product. And I've spent a lot of my time outside the US in my life as well, and certainly know that the product that a retail investor gets here is superior to what you get in Europe, what you get in Asia or in the rest of the world, etc. So it is significantly better. So while we can always get better and strive for better, etc., I think sometimes we lose sight of the fact of just how good a product it is as well.
Yeah, I agree, but I'm not willing to concede why it's better, because I think it's better because we're the biggest and most liquid market. And I if you look, there are brokers that give that same experience without accepting payment for order flow, without defaulting to a wholesaler internalization. They route, they find the best price, and there are a lot that don't. And we in the OCR proposal, the SEC showed the payment for order flow is 20 cents on average, right? It's not enough to translate to zero commission. It's not really what did it.
Sure, I think that's couple things on that. The talk about the biggest, most liquid market in the world, would it be that without the market makers? Maybe not, right? I think I remember seeing something from, I think it might have been XTX actually, that did some analysis, and they actually thought that actually Japan was the most liquid.
Yeah. We cited that study in our OCR comment letter. And
there you go.
It's a matter of size, market size, not market efficiency. Because for the same sized orders in the same size companies, when you control for that, Japan is cheaper to execute. Korea, cheaper to execute until you hit like their transaction tax threshold. And Europe, cheaper to execute.
Right. Yeah, look, I think that's, you've got a couple pieces in there. We've got frictional taxes, charges, those sort of things, etc. We talk a lot around spreads. When we get into the market of microstructure, etc. If you're a trader, a retail trader, and you're just trying to buy things, invest, spreads is the last thing you should care about, right? What if you're a market maker or you're someone?
If spreads are 30% wider than they would be outside of a system dominated by internalization, that is something to care about. And
what you care about is price,
but certainly for retail.
Yeah, you should care about price, right? Can I buy this thing cheaply? The only person that cares about the spread is the one that wants to turn around and sell it instantly, right? And that matters for them, right? If I'm just trying to buy,
is what they're being benchmarked against. So best execution.
Yeah, absolutely. And I know we talk about this, right? But I sort of love the. I said I wouldn't do this and say anything funny, but I hate the player, not the game. Hate the game, not the player. Sorry, right? It really is that these people are operating within the bounds of the rules that are set, right? I don't think hating on them does much benefit when there's a law that says this is how they can operate, etc. And they're trying to get maximize that from a business perspective and from a trading perspective. But I do think that the game can be improved as well.
Yeah. So all right. I got to ask you one question before we get to improving the game. I tweeted a while back now, I don't remember when, about the excess capital charges in the January 2021 events, and you think these charges are stupid, and it has been brought to my attention repeatedly that Instinet had these massive charges. And for 2 years before those events, had 50 billion of the $67 billion of charges waived, like repeatedly waived. I'm not, this is not an area of expertise for me. I know the basics, I kind of understand what this means, but I don't understand the backstory here. I feel like you know a lot more about this than I do. Why is it that Instinet would have had 2 years of charges like this and those charges waived? And why do you think this is a big deal or not?
Sure. I don't, singling out any one firm or anything like that. I think it's better to look at the process behind. And it's certainly something that gets applied across the market. The NSCC margin calculations uses a number of factors which go into it, right? The core of their margin calculation is a 150-day rearward-looking parametric VAR calculation to work out to try to use history as a proxy for forward volatility over the 2 days of settlement that we would have.
Right. So VAR means, for those that don't know, VAR is value at risk, and it's a measure of how much can these things change in the next day or two, so that I understand how much capital you need to put up in order to protect the clearing process from the worst, the most volatile move.
Exactly. Right. And, for most of my, working career, and I know some of yours as well, at the bottom of our emails, there's a little bit of script that says something like, past performance is no predictor of future activity and things like this, right? But this calculation uses history to try to predict the future. And, so they need other things on top of that. And they have a mark to market, right? The movement has just happened today, last day, etc. But then they have these other metrics that they apply. Some of them are disclosed, but some of them are not disclosed. And it's this lack of disclosure and transparency that myself and some of the others in the industry take the most issue with. Because if you're running a business, right, you need to be able to put up capital to do your business, etc. And that's great. But what if I came and told you today that, all those rules you read and everything else, etc., that said you had to put up $1 billion, today I'm telling you it's $4 billion. Mm-hmm. That's the level of craziness that happened there, right? And they waived it because, they realized it was crazy, but it's an indicative calculation that they have that's non-disclosed to the market, right? So why would it be waived? It would be waived because, cooler heads prevail type of thing, right? And they realize that these sort of capital calls are, not only unnecessary, but they're almost dangerous to the industry, right? And that they can bring down counterparties and create a catastrophic event. But you got to go back to what we talked about earlier. Why are they needed? They're needed because the trades are novated, which is like the change of ownership from, if you and I traded together in the market, Dave, what happens at the end of the day is both of our trades get novated to face this central counterparty. So you're facing the central counterparty, I'm facing the central counterparty. That central counterparty needs to have the money to do all of that, and they need to call it. So when things get volatile, they just think they need to get more and more money, right? So if you think about that over time, as the market gets bigger and more volatile, that is a never-ending pool of money that will always continue to grow, right? Things like changing the number of days in the settlement cycle get you a bit of a reprieve, but it'll just keep growing from there and keep going up again as well, right? The model is something that worked very, very well in the past when we had 40, 50, 100 clearing brokers taking a small part of the market and doing something there. But now you've got this concentration in this massive market that becomes a little bit difficult to deal with.
So a lot of the attention during the meme stock hearings after this happened was focused on Robinhood, but Instinet was just such a larger number. And I know you don't want to talk about specific firms. I get that, but is it that that's the concentration you're talking about? And as a clearing broker, they simply were responsible for far more gross positions. Is that the problem?
No, I mean, look, Instinet is I'm a big fan of Instinet. For the longest time, Instinet has been trying to innovate and been a great part of the industry because they're not conflicted by a lot of things that other people are. And that conflict comes from principal trading activities, etc. Instinet are an agency brokerage, right? And they've always been very clear about that in what they do for the industry. What happens to them sometimes is you might run a couple of big block trades and then you have some volatility here and some other things. And suddenly an esoteric calculation inside the NSCC says that you owe a whole lot more money, right? But they're not, taking, risk there other than the clearing risk in the facility there at the NSCC. So I think that for someone like them, they really get penalized more than others because they're a very big, successful firm that tries to do things the right way, but you can only do that so much as you can, do the calculation yourself. And we speak to a lot of people on the street, and everyone's tried to, back in the calculation for calculating what this call could be. And everyone tells me they've got it pretty accurate, but as soon as things get volatile, they could be out by 25, 50% or orders of magnitude, right? It goes all out the window at some extreme situations. And that's very, very difficult to run a business on day to day.
So is this 2 years of waiving excess charges just an indictment of like what you're saying, the calculation itself, and like why haven't they changed it if everyone thinks this is really crazy?
Sure. Change costs money, right? Both for the institution that needs to change and, right now there's no competition and you can't go anywhere else. So why should they change? What is the incentive for them to change? It all comes back to where we started. There's competition is needed in the market for things to drive forward. Why does the US market have such a great product? Because you've got a lot of competition fighting to improve and compete. and people like Robinhood who take it on the chin for, you know, a lot of the industry there,
You're also a
etc.
Robinhood fan. We should have put up that disclaimer.
I'm a fan of all of these brokers coming in and trying to innovate, right?
Yeah.
Robinhood, you know, public.com, others we've spoken about, these sort of guys, etc. You know, they do great things in the market. Instinet, I think, of in the same mold of like trying to innovate and push the market forward. All of these guys, and there's a lot of them in the industry there. I think that, you know, do they get everything right? No, right? But I thought the really humorous thing in that whole scenario that happened around the capital charges is, of all the firms that could overnight suddenly find an extra $3 or $4 billion, Robinhood is probably the only one that was in a position to do that because of the growth they were seeing and their investor base and everything else, etc. So the fact that they took the pain for everyone else, you know, I found quite interesting to watch from the outset.
All right, so that's the perfect seg. We're talking about competition. Let's talk about the order competition rule. Let's talk market structure. We got to geek out for a little bit. You know, front office equity market structure. You know, I got to say, when we launched We the Investors, you know, you and I spoke a lot about the kind of changes we would want to see in equity markets. Paxos was a supporter of us when we launched, and we truly appreciated that. You know, what do you think overall in terms of what ended up coming out in these market structure proposals? And what do you think of the order competition rule specifically?
Yeah, you know, I would have loved to have seen, obviously, selfishly talking my own book, I would have loved to have seen more focus on the clearing infrastructure there, right? You know, we had...
A lot of people felt that way,
Yeah, you know, 2 years ago, we put our initial application in, and we've been working with the staff at the SEC, you know, over the last 4 or 5 years now, to really build upon that and get it to the point where they feel it can move forward to public comment, right? And we continue to try to, you know, march towards that end goal. But that's what we really want, is clearing competition there. So slightly disappointing that there was, you know, focus on a lot of other areas other than that. You know, I felt that certain people got away scot-free, certain institutions in the market that should have been more focused on, but things there. And I do feel that there was so much attention given to wholesaling and the market makers there, etc., that it felt like an easy target for the SEC to go after there. Now, I know there's been studies, you know, around savings that could be had and those sort of things, and you know those better than I do too. And I understand that as well. But going back to the fact that, you know, the US retailer is getting a very good product. Could it be better? Yeah, maybe. But I think that I worry about the number of things happening and the speed at which they're trying to push some of them through, right? Because unintended consequences are big in these markets, right? When you have such a highly evolved, highly integrated market structure, it's very easy to do something well-meaning on one area and have really bad, you know, impact in others.
Yeah. So let's. It's funny because I hear from a lot of retail investors, they're like, why isn't the SEC doing anything? And I hear from a lot of the industry, like, why is the SEC doing so much? So they can't win. That's fair. And, you know, I get what you're saying about wholesaling, but when we were talking, you know, you knew that part of our platform was a trade at rule. And, you know, to me, that's how you get sort of the best of both worlds, the best competition on one side and the best spillover effects in terms of spreads and market liquidity and even likely volatility on the other. And frankly, like the best price discovery, because, you know, when you talk about the benefits of market making and the, you know, market makers using the Madoff exemption, it to me, that's distorting supply and demand. And I don't know that I see the issue with letting markets find the price, you know, given supply and demand.
Yeah. No, you're right. And it's always going to exchange. And I think it's actually important to define exchange here, right? Exchange meaning a displayed order book with market data feed going out to people, right? Despite the fact
with
they
fair
have
access
that don't go out, with fair access, etc. Right? And anonymous fair access too, right? Is a really, really important point. And what that comes down to is when you look at the market today, if you went back 20, 30 years, a market maker could easily see the difference between a retail order and an institutional order, right? Because one was big, one was small, right? But what we've done is in building trading algorithms, we try to break up the institutional orders to hide them, right? And break them up into lots of little pieces, right? And that means that a market maker really can't tell the difference anymore. You're trading 1, 2, even odd lots these days are traded via institutional algorithms to try to break things up and get best price there for people. But what that means is if I'm a market maker, I'm in a knife fight, right? I don't know what the other side is there. I don't know if that's the first share of a 100,000 share order or one share from Dave Lauer trying to buy a little bit of Apple here, etc. Right? Sure. So I am going to treat it as protectively as I can and trade aggressively out and in and those sort of things, etc. What wholesaling brings is the ability for Dave Lauer to come and say, well, I only want to buy one share. So treat me a little bit nicely and don't aggressively hedge out of this and these sort of things. That's the idea behind it, right? So, you're cutting out the exchange, right? And you're going direct to the wholesaler there so that he knows and he can profile your flow and know, okay, yeah, Dave Lauer's not a toxic trader. He doesn't move prices around massively. And, so I can give him, a really good price, knowing safely that he's not going to move the price against me and affect me and those sort of things. Right. That's the premise behind it, right? It's a really good premise to get retail a better thing there. Whereas if I'm going on to...
Well, what the end result is that exchanges are simply toxic cesspools, right?
Well, I mean, yeah. But it's I don't want my exchange friends to come away with that comment, right? But yeah, it's you could say that, right? But
because where price discovery is supposed to happen.
Yeah, right. And that's the thing. You've got to balance price discovery, versus liquidity and everything else, right? Are we really affecting price discovery by not having that retail flow in there? Because don't forget, right? A market maker. Let's take the example of a Citadel or a Virtu that people talk about most in the market there. They are market makers.
Because they own 70% of the market and it's an effective duopoly. Go ahead, sorry.
Because they enable liquidity across every market there that we have, right? But don't forget, when they take a wholesale trade in, right, they're taking that inventory. What are they doing with it, right? They're then making markets on the exchanges. Right, that liquidity it gets recycled in and out across. Right,
it's amazing the informational advantage they have over other on-exchange market makers as a result.
Sure, right, but there's very few market makers that don't get involved in these other businesses to build liquidity and everything else. Right, it's having your finger in every pie allows you not only to read the tea leaves of what's happening and market demand signals and everything else, but also to pick up cheap inventory to be able to recycle and come out. And for a time that was seen as a really positive thing that they did in the market. The dialogue has certainly shifted on that to a degree. But they're there trying to make money, right, out of spreads within the game that's been put to them of you can do these certain things, but you've got to provide liquidity, you've got to be there for people, etc.
Yeah, okay. But so you think in a trade at regime where all small orders are going on exchange, that net, and let's not talk about specifically every retail order, but in aggregate, both retail orders and institutional orders, which is where the majority of retail's, individual investors' wealth is held. So I hate the delineation between institutions and retail because I find it very hard to point.
People forget the fact that the biggest pool of retail is in, the funds and institutional and the BlackRocks and Vanguards of this world, etc. That is the biggest pool of retail money.
That's right, exactly. So the wealth of American savings and many around the world is in these institutions. But even for self-directed investors, you think if everything goes to exchange, the spread compression is not enough to offset that quote unquote price improvement they're getting from those, relative to the wider spreads we have today?
Sure. I think I don't know the answer and it's untested, right? And I think that it's a hypothetical about what could happen, right?
You don't think the tick size pilot trade at group was evidence enough of what it looks like in U.S. markets? Because there were some pretty good results in there.
Yeah, look, absolutely, right. And I just think that it should be stepped into in a similar sort of frame of, testing and trying to work with it, etc. Rather than any big bang approach, right?
Yeah.
I do believe in that for sure. But those tests
Fair.
are also expensive, right? They're attacks
Right.
on the
And
industry as well.
they tried to do an access fee pilot, and look what happened there, right? The industry sued, the exchanges sued, and got it blocked.
Yeah, look, it's a tough model, right? But spreads for the longest time have been mandated, right, in a lot of markets, and part of that is because for people that are making markets there, they want to know that they can make a market and model up what they can get in and get out and these sort of things, etc.
Yeah, when markets are locked, the wholesalers just shut down. If there's no spread, they won't trade.
Exactly, right. And I think that is the dynamic that people do. And when you look across international markets and others with fees and charges in the market, sometimes spreads are very narrow, right? And that's why you don't see it. And there's certainly no market maker regime that allows people to operate the way they do in the US. For most of the developed world, they don't allow rebates and they don't allow zero commission either, right?
Mm-hmm.
You have to charge a commission. So, I think if you then look at the US product we have there, I think any changes they want to do should just be so cautiously applied. Right? The studies are good, but
in Canada, we don't have zero. We don't have, we have zero commission in Canada and no payment for order flow or wholesaling. Same thing in the UK, same thing in Australia, same thing in Singapore. A lot of good examples where they have determined payment for order flow incompatible with best execution, and also you get zero commission trading.
Yeah, for sure. And look, they're comparatively small markets, and that's the problem with would that work here type analogy. And what will it mean for people? And I think the US market is interesting in that now retailers are quite often getting free trading, no commission trading, etc.
Even though we like to say free trading ain't free. They're not paying explicit costs, right?
Yeah, but people forget that prior to the current world that we're in, you used to pay a commission and the broker was getting rebates.
Yeah, that's right.
Right? Yeah. People just realized that they could run a broker on a thinner margin and they didn't need to charge both, and potentially that would go. And obviously what's happened since these things happened, trading volumes have gone up, participation's gone up, and these sort of things. So I think that, again, we can't lose sight of those anecdotal points about the product and participation.
Okay, totally fair. We've gone on really long here. This is what happens when two market structure nerds get together and nerd out. We could keep going, I think, for another hour. Maybe we will another time, but really enjoyed the conversation, Greg. Thanks for joining us. And I hope everyone listening enjoyed that too. And we'll try and provide some guidance on some of those terms because I know some of that got a bit deep, but I think that was great. What'd you think, Pink?
I followed along well, so and I'm pretty smooth brained, but we definitely, of course, will provide some visual content to go with what they were saying. But super interesting conversation, and we really appreciate you coming on and talking some of the plumbing and mechanics behind how we trade. So thank you very much, Greg.
My pleasure. Thank you.
Yeah, and it's great to get a voice who, in a very eloquent and learned way can disagree with me. I think it's important for everyone to hear different perspectives. Again, thanks for listening to Let's Talk Markets. We're going to have our next episode coming up, Macro and Markets, with our, return panel of Claudia Ophir and Kyla. We're looking forward to that. And that's going to be our Christmas present to you, our listeners. We're going to record it at the end of this week, but it will come out for Christmas. We're excited for that. And then for a whole new year of Let's Talk Markets coming up.
And new season. We'll be wrapping up season 2 with that one. So we'll be starting the year off fresh with season 3 and a whole new panel of topics. So
there we go. Yeah, it's so this has been a lot of fun and a great year for the podcast. Again, thanks everyone for listening. We see those subscriber numbers moving up. We see those ratings coming in. Every little bit helps. So, if you haven't, make sure to subscribe. Make sure to give us a good rating if you love it. And, leave some comments on YouTube. We love seeing the comments. We try and incorporate any suggestions or questions for future episodes. Have a great holiday and enjoy some time with friends and family.
Take care.
You too, then.